Hello, and welcome to Finance Weekly Briefing, your concise roundup of the week's key economic and market developments. Currencies were led by the euro-dollar pair after signals from Jackson Hole. It was reported that Chair Powell sounded more concerned about labor market softening than inflation persistence, which was read as a dovish tilt. A September rate cut was priced with high probability, and risk appetite improved. Dollar yields fell, and EUR/USD climbed quickly from near 1.16 toward 1.1740 before starting the new week close to 1.17. Attention was directed to upcoming U.S. data, with non-farm payrolls due on September 5th and inflation the week after. Before the September 17th Federal Reserve meeting, labor and price figures were viewed as decisive. The new week began with thinner data. It was indicated that Friday would deliver an early look at euro area August inflation through national flash releases from Germany, France, and Spain. In the meantime, EUR/USD was described as trading within a 1.16–1.17 corridor. U.S. consumer confidence softened and inflation expectations ticked higher, but the dollar briefly firmed as enthusiasm for aggressive Fed easing faded. The pair tested a break below 1.16, but settled near 1.1650 by the end of the session. Scandinavian currencies benefited from stronger risk sentiment and local signals. It was observed that EUR/CK fell to the lower end of its recent range near 11.13 and later edged toward 11.07. EUR/NOK dropped below 11.80 and held near 11.75 into month-end. Riksbank minutes suggested that the recent inflation uptick was still considered transitory, though vigilance was described as higher. It was noted that the door to additional cuts remained open, but a higher bar for near-term action was implied. In Norway, support for the krone was helped by a modest lift in oil prices, and expectations that Norges Bank, after beginning its cutting cycle in June, could proceed gradually through the rest of the year. Day-to-day moves reflected a balancing act between political noise and data gaps. It was recorded that France prepared for a confidence vote on September 8th, while U.S. focus was trained on the Fed amid a dispute involving Governor Lisa Cook. EUR/USD held the mid-1.16s during quiet trading sessions. On one day, the dollar briefly strengthened toward 1.1580, but the pair retraced to the 1.1640–1.1650 area by the following morning. Technical reference points were cited near the 50-day moving average just above spot and the 100-day average near 1.1510, with traders watching those bands into month-end. Outside Europe and the US, the Australian dollar faced mixed forces. It was reported that Australian consumer prices accelerated in July to an annual pace near 2.8%, reflecting the expiry of electricity rebates and broader price firmness across goods and services. The Reserve Bank of Australia had lowered its cash rate to 3.60% in August, and markets inferred that further easing would likely be delayed until later in the autumn given the inflation tone. As a result, AUD trading was described as cautious, with sensitivity to incoming domestic prints and global risk appetite. Interest rates shifted as investors recalibrated policy paths. After Jackson Hole, U.S. yields fell across the curve on a dovish reading of Powell's remarks. Markets were reported to price 125 basis point cut for September and a second cut for December, while leaving later steps dependent on data. By midweek, some of the post-Jackson Hole momentum faded and yields edged higher on both sides of the Atlantic as focus turned toward end-week inflation prints. Euro area bonds rallied intermittently, but spreads continued to widen where fiscal risks were prominent. Later in the week, the U.S. curve was said to have flattened as longer maturities dipped a few basis points. Fed Governor Waller indicated that a 25 basis point cut in September appeared most likely, but that a larger move would be considered if the next jobs report showed meaningful labor deterioration. Markets were guided to the core PCE price index as the preferred inflation gauge, with a modest monthly increase expected. Eurozone markets stayed sensitive to political and fiscal headlines, and the France-Germany 10-year spread was described as widening toward multi-month highs near 80 basis points. In Sweden, rate-setter communications reinforced patience. It was conveyed that the board still believed the summer rise in inflation would prove temporary, though pricing intentions in retail and consumer confidence were being watched closely. Economic tendency indicators showed a broad but modest improvement, while upcoming Swedish inflation data next week was flagged as pivotal ahead of the September decision. In Norway, The first rate cut of the cycle in June was followed by guidance, suggesting a slow path of additional easing into year-end and through 2026. Euro area sovereign dynamics remained a focus. It was observed that French spreads relative to Germany continued to widen as markets weighed political uncertainty, budget consolidation plans, and a large debt stock. German yields tracked global duration moves, while country-level inflation prints for August were expected to set the tone into the euro area flash estimate. Across the Atlantic, U.S. data resilience was underlined by an upward revision to second-quarter GDP to roughly 3.33%, supported by strong consumer spending and increased investment in artificial intelligence capacity. The growth beat was absorbed alongside falling long yields, reflecting confidence in a soft landing path, tempered by near-term policy easing. Commodities provided only light directional cues. It was noted that oil prices firmed slightly, giving marginal support to the Norwegian krone. Broader commodity flows were overshadowed by trade policy headlines, including rare earth supply discussions, which were said to oscillate between temporary disruptions and normalization. Industrial metals were monitored for sensitivity to Chinese risk sentiment, as Chinese equities were reported to have rallied on hopes of domestic easing and AI optimism, despite lingering property sector concerns. Geopolitics added a substantial layer of uncertainty. In the United States, a legal dispute was initiated after an attempt was made to remove Federal Reserve Governor Lisa Cook from office. It was stated by Governor Cook and counsel that such removal authority did not exist, and judicial review was sought. The episode was judged by markets as a potential challenge to central bank independence, with possible implications for term premiums and the dollar if institutional credibility were to be questioned. In Europe, France moved toward a confidence vote set for September 8th. It was communicated that large proposed spending cuts and tax increases faced strong opposition, and political risk was seen rising in the short term. A narrow survival path was described for the Prime Minister, with the possibility of leadership change if the vote were lost. The situation was associated with the widening of French spreads and a more cautious tone in euro assets into the vote. Across Atlantic trade policy, higher U.S. tariffs on India were announced and were set to take effect mid-week. The measure was positioned as a response to India's discounted purchases of Russian energy. It was indicated that India would seek alternative export markets in Asia and Africa, while maintaining the stance that oil would be sourced where prices were lowest. The action was viewed as a headwind to one of the world's fastest-growing economies if sustained. Separately, it was stated that hedge funds increased short positions in the VIX to levels not seen since 2022, reflecting expectations for continued market calm, even as tariff and political risks accumulated. U.S.-China relations remained in focus. It was stated that Washington's leverage over certain aircraft components was being emphasized, while China's rare earths shipments to the United States were described as previously suspended and later normalized under a temporary arrangement. Despite intermittent tensions, Chinese equity volumes were reported at new highs on the week as domestic stimulus hopes and AI themes outweighed trade and property concerns. Market participants were prepared for renewed volatility should tariff rhetoric escalate or supply chain frictions reappear. In security and diplomacy, prospects for a meeting between the Russian and Ukrainian leaders were portrayed as remote. It was reported that no clear pathway to negotiations had been established and that positions remained far apart. Parallel diplomacy involving major powers was said to continue, including planned conversations on energy flows and pipeline options in Asia, but no direct breakthrough for the European conflict was indicated. The persistent stalemate maintained a background bid for safe assets during periods of risk aversion. In central bank communications beyond the Fed, it was noted that ECB President Lagarde emphasized the importance of central bank independence while recognizing the need for accountability to elected bodies. Additional commentary from ECB officials suggested that policy had entered a monitoring phase, with less urgency for active changes unless data dictated. Bank of Japan Governor Ueda indicated that Japan's tight labor market was expected to generate wage pressure, with demographic trends contributing to labor shortages. It was highlighted that foreign workers represented a small share of the total labor force, but accounted for a significant portion of labor force growth from 2023 to 2024. Market internals reflected an absence of a single dominant theme. It was observed that defensive and cyclical equities performed similarly through late August, while the prior outperformance of growth cooled. Small-cap gains in Europe lost momentum, and the VIX stayed below 15 for a second week, marking one of the lower volatility months of the year. Despite the quiet tone, rate-sensitive assets stayed highly reactive to each incremental data point as investors calibrated the path from restrictive policy toward a neutral stance. Looking ahead, the key watch points were clearly defined. In the United States, the personal consumption expenditures inflation data was anticipated at the end of the week, followed by the labor market report on September 5th. The combination was expected to inform the size and pace of the Fed's easing path into year-end. In the euro area, national inflation prints would set up the flash CPI, with attention on services disinflation and any surprise from energy components. In Sweden, next week's inflation release was flagged as critical for the September Riksbank meeting. In France, the September 8th confidence vote was expected to drive near-term spread moves and risk sentiment for euro assets. Thank you for watching Finance Weekly Briefing. Subscribe to stay updated on the latest market and economic news.